Okay, here we go with Chapter 4. Let me talk for a moment or two about Chapter 3. It is vitally important that you understand Chapter 3 and all of the concepts. If you do not, the rest of this textbook will be like it is written in a foreign language. You need to understand how to do the transactions in the spreadsheet, how those work in increasing and decreasing accounts, how you need to keep the spreadsheet in balance so that your numbers work out when you move them to financial statements. Chapter 3, in many ways, is the most important chapter in this book. So make sure you understand that chapter. Now, if you remember, at the end of Chapter 3, we had completed doing the transactions for the month for a company, the daily transactions. We had recorded sales, we had recorded expenses, and so on. And we prepared an unadjusted financial statements. What does that mean, unadjusted financial statements? Well, think back to the first part of Chapter 3 when we learned about the qualities of useful information. We learned that, in this textbook's words, that financial statements needed to have a faithful representation, they needed to be relevant, and they needed to be timely. What I always say are financial statements need to be accurate, useful, and timely. Saying the same thing, just in different words. The financial statements that we prepared at the end of Chapter 3, while they might have been accurate to that point, they were not accurate as far as the company was concerned, because we had not made any adjustments. What are adjustments? Well, we had prepaid items. We also had unearned revenue. We had other things that maybe we had not accounted for yet, because those items are not part of the daily operations of the business. They are things that we do at the end of the month or a quarter or a year, when we look at our numbers and determine if they're correct. This chapter is going to help us learn about those adjustments, how we make them, and why we make them. So let's get started. We've talked about, this is that word I cannot say, periodicity assumption. In every other textbook, it's the time assumption, or something like that, but I guess these people like this word, so we'll use it. We divide the life of the company into periods of time. If we just kept the books, let's say the operations, the income statement, from the first day of the company until the end of the company, what good would that be? It would be a massive thing, of course, but we wouldn't have any means of saying, well, for this year, this is what I did, or for this year, this is what I did, because it would all be lumped together. So we divide the life of the business into time periods. Many companies like to prepare financial statements on a monthly basis or a quarterly basis. Those are interim financial statements. And then at year end, we prepare the final financial statements for that particular year. Publicly traded companies are required to prepare financial statements quarterly for their stockholders, and then the annual reporting at the end of the year. Some companies operate on a calendar year. A calendar year starts January 1st and ends December 31st. Other companies operate on what they call a fiscal year. It may start March 1st and run through the end of February, or it may start July 1st and run until June 30th. It's a 12-month period of time, but not necessarily based on the calendar. Now we're going to start learning some new concepts. I know. How many new concepts can we learn in one class? Well, in this one, it'll be a lot, because these are all things that you have not thought about before. So the first thing we'll talk about is the revenue recognition principle. We recognize revenue when it is earned. That's the easy way to say what this slide is saying. When we earn the revenue, we recognize it, meaning we book, we enter as a transaction that revenue. All month long, I do payroll for my clients. I am earning that revenue as I'm doing the work. Haven't been paid for it yet because I bill my clients at month end and then I receive payment in the next month. But I recognize the revenue when it is earned. Illustration, this company provides dry cleaning. Customers do not come in and pay for it until the following month. In order to recognize that revenue, because it's already been earned, the service has already been done, we would increase our revenue and also increase our accounts receivable. Next month, when they come in and pay, we would increase our cash and decrease our accounts receivable. I believe that's one of the concepts that was a little difficult in Chapter 3. The same thing applies to expenses. We recognize expenses when they are incurred. And they're generally incurred during the same time period that they are being used to generate the revenue. So we recognize income when earned and expenses when incurred. So here's a nice little chart for you, saying just what we've been saying all along. Now, these assumptions, these principles are part of GAAP. Meaning, if you're a publicly traded company, you must follow these assumptions or these principles. And if you are not a publicly traded company, it is highly recommended that you follow these principles. These principles, the recognition of revenue when earned and expenses when incurred, is referred to as accrual-based accounting. We record the transactions in the period in which the events occur. We take cash out of the equation. We're not worried about when we paid for those items or when we were paid for the services. We are merely looking at when did the event happen. And we recognize our expenses or our revenue in those times. Cash-based accounting, on the other hand, so we only recognize revenue when we get the cash in, so we have no accounts receivable, and we only recognize our expenses when we actually pay for the items, so we have no accounts payable. It's not in accordance with GAAP, but there are many, many small mom-and-pop stores that operate on this basis. In fact, for IRS, for filing taxes, if you are not a corporation, if you're a sole proprietor, you're pretty much expected to be working on a cash basis and not an accrual basis of accounting. This is an illustration. You know what I'm going to say next, don't you? I think it's a very poor illustration, but it's the way it is to grab your attention. Fresh Colors Paints. It incurred and paid expenses of $50,000 in 2016 when it did a large painting job that it billed the customer for $80,000, but they didn't get paid until 2017. So look at the difference. Under accrual-based accounting, we would recognize the revenue of $80,000 in 2016 when that revenue was earned, and also recognize our expenses, so showing a net income of $30,000. On the cash basis, because we received no revenue in 2016, assuming that was the only job the company did, but we did have expenses, we would show a $50,000 loss in 16 and an $80,000 profit in 17. So this is an example that very glaringly shows you how that, by using cash basis instead of accrual basis, can really misstate financial statements. So why do we need adjustments, and what are adjustments, and where do they come from, and how do we know? I'd like to say right now it's magic. No, it's not. Sorry, I couldn't help myself. Adjustments ensure that we are following the principles that we've just talked about, that the accounting principles are followed, and that we are in accordance with GAAP. Anytime we prepare financial statements, we should look for and record any adjustments that are necessary. Every adjustment will include one income statement account and one balance sheet account. Adjustments will never, ever impact the cash account. Okay, let me say that one more time. Adjustments will never impact the cash account. Other assets accounts, yes, but not the cash account. Keep that in mind. There are two types of adjustments that we'll talk about. We'll talk about deferrals, and we'll talk about accruals. Silly words, huh? Deferrals means that we're going to postpone or delay these items. We're either going to postpone or delay the expenses, or we're going to delay recording our revenues. Prepaid expenses, things we pay for in advance. We had an example of that in Chapter 3, I believe it was prepaid insurance. Unearned revenue. People give us money before we perform the service. That could be a retainer for an attorney. That could be buying gift cards. Money is received before services are performed. Accruals, on the other hand, means, excuse me, I am sorry, I believe I'm catching a cold here. Accruals are items that have not yet been booked into our accounting records, but we know that they're there. This could be services that we've performed, but we've not yet either been paid for or we've not yet billed the client. Perhaps I'm doing a large job for a client and I have it halfway completed in June, but I'm not going to finish it and actually bill the client until July. Well, the revenue recognition principle says that I should recognize the revenue that I have earned in June, so I would accrue those revenue. Accrued expenses. Expenses that we've incurred but we've not yet paid or recorded. One of those is income taxes payable, or perhaps salary and wages payable. And we'll talk more about these as we look at some adjusting entries. This is the ending spreadsheet from Sierra Company from Chapter 3. You may want to turn in your book to this particular spreadsheet so that you can kind of follow along as we're talking about our adjusting entries. And the spreadsheet would be located on page 91 of your textbook. So let's look at this. What do we have here? We have supplies. We know that we bought a lot of supplies last month. Do we still have $2,500 worth of supplies on hand? What about that prepaid insurance? Wow, what about equipment? Is it still worth $5,000? We have a notes payable, and that probably had interest. And unearned revenue. Have I earned any of that? You see, there's lots of questions. Now, when we were doing transactions, if we were in the real world, you would have a piece of paper, a receipt, a check, an invoice, something that you're using to record our daily operating transactions from. When it comes to adjusting entries, it is our knowledge that will allow us to create the entries that are necessary. Nobody's going to hand us a piece of paper and say, oh, here, these are the adjusting entries. So we have to look at these accounts, remembering that we want our books to be accurate. Is this, what we see in front of us, an accurate representation of our company books? And we know the answer to that is no, not really. We need to do a few things. Deferrals. It's either going to be a prepaid expense or an unearned revenue. Pretty simple. We've either prepaid something that we deferred and now we need to expense, or we received monies for jobs that we had not yet performed. So our deferrals are one or the other of these items. Prepaid expenses. They were paid before they were used. Insurance. I believe that was our example in Chapter 3. We paid a 1-year insurance policy. Sometimes you will pay rent, maybe 3 months at a time. Supplies. We buy supplies and we know those are an asset until they're used up. Various things. Equipment and buildings. How can that be a prepayment? We'll talk about that as we move forward. Prepaid expenses are items that are used up with the passage of time or because we're using them. The insurance policy, it's the passage of time. Supplies, it's because we're using those items. An adjustment results in either an increase to an expense account and a decrease to an asset account if it's prepaid expenses. So you're going to increase an expense and decrease an asset. Well, that makes sense because the prepaid were prepaid expenses. So if I'm using them up, then I want to increase my actual expenses. And here we're looking at a partial part of our spreadsheet. It increases an expense account and it decreases an asset account. Remember, everything has to fit in our accounting equation, and the accounting equation must stay in balance. So while we're increasing an expense account actually decreases stockholders' equity. So we actually have decreases on both sides. Confusing? Yes, I get it. Okay. Sierra Corp had purchased $2,500 of supplies back on October 5th. So now at the end of the month, we go count our supplies and we discover there's no longer $2,500 worth of supplies in the supply cupboard. There's only $1,000 still on hand. So we need to reduce our supplies by $1,500, and we're reducing our equity by increasing our expense by the same $1,500. So our entry balances, we've got an ending balance in our supplies account of $1,000, which matches what we counted. We also have $1,500 in supplies expense, which is what we determined is what we used. Next example is insurance. Do you remember when we paid the $600 for a 1-year fire insurance policy? Started on October 1st and runs through September 30th of next year. Well, at the end of October, all $600 of that insurance policy is no longer prepaid. We have used 1 month of that. So 600 divided by 12 says that our insurance cost us $50 each month. So we need to reduce our prepaid insurance and increase our insurance expense, which reduces our stockholder equity. We now have $550 left in our prepaid insurance, which, if we take 11 months at $50 a month, is the correct amount. In this case, by the passage of time, we have used up. In the case of the supplies, by actually using the item, we have used up some of the supplies. Now this is a whole different concept, so kind of hold on to your hats. We'll really get into this in future chapters, but let's introduce the concept now. I know you've heard it said, and it may have happened to you, that if you buy a vehicle, as soon as you drive it off the lot, it's not worth as much as it was when you paid for it 5 minutes before that. All of these things, buildings, equipment, plants, vehicles, are things that are used in the business. They're not being sold by the business, but they are being used to do what we are in business to do. We also learned in the previous chapter that we record these items at cost in the year in which we acquire them. But if they're being used in the business, why don't we make them an expense? Everything else we use in the business is an expense. Our supplies, our insurance, our rent, our utilities. We're using this. Why isn't it an expense? Because it will last longer than 1 year. We will use these fixed assets or capital assets for longer than 1 year. Some of them will be for 30, 40 years, but we will be using them for a longer period of time. So we record them as an asset. What's an asset? That's right, something we own of value. But we're using it in the business. We need an expense. That's what depreciation is. Depreciation is the means of saying that, yes, we know it's being used in the business, so we're allocating a little piece of that cost to an expense account every month, every quarter, every year to show that, although this is an asset, it's gradually being used up in the business. Now, we are not trying to match the change in fair market value of the asset. We are merely trying to show that the item is being used up because it's being used in the business over a long period of time. That's what depreciation is. Did I confuse you? Hang in there, we'll talk about it more as we go along. In our books, on our spreadsheet, we will now have a new column called Accumulated Depreciation. Accumulated depreciation will be all of the appreciation to date for that piece of equipment, that building, that vehicle. Well, why don't we just reduce equipment, you say? Because, I say, that would violate the cost principle. Remember, our assets, our fixed assets, we record in the books at their original cost, and they are not adjusted based on fair market value, increases or decreases. So I want to leave that on my books, my equipment that costs $5,000. So I use accumulated depreciation. Accumulated depreciation is called a contra asset account. It is contra asset because its balance is opposite of normal. Asset accounts normally have a positive number as their balance. Accumulated depreciation will also always have, or should always have, a negative amount as its balance. So it's a contra asset account. Our entry then is accumulated depreciation, equipment, and stockholder depreciation expense, which reduces our stockholders' equity. Now remember, these accounts are the sum total of every entry in them since the beginning of time. So we'll continue to accumulate depreciation. The balance sheet is the statement of the financial position of the company as of a certain date. Over here, our revenue and expenses, until we combine them into retained earnings, are showing our operations for a period of time. So our depreciation expense will always be for only one period, while this number here, the accumulated, will be all of the depreciation to date. On the statement, on the balance sheet, which is the financial statement that our assets appear on, this is how these numbers will appear. Do you remember our classified balance sheets? Okay, you saw this already. So the accumulated depreciation appears directly underneath the item it's offsetting, and we show what is called the book value on the balance sheet. Book value is the difference between cost and the accumulated depreciation. Book value has nothing to do with Kelley Blue Book value or any of the other like used equipment guides. Book value is strictly the difference between our original cost and our accumulated depreciation. Prepaid expenses. A lot of different things. Insurance, supplies, advertising. We've originally recorded them in asset accounts, and as they're used up, we move those amounts over to our income statement as expenses. If we did not do this, if we left all of our supplies on the balance sheet, we would be overstating our assets. So we must make these adjustments so that our books are accurate. Unearned revenue. We've received the cash, but we have not performed the service or completed the job. Things like rent, airline tickets, deposits, retainers, gift cards. All of those things are unearned revenue. And at the end of the month, we need to determine, have we in fact earned some of that revenue? When we make the adjustment, we're going to increase our sales, our revenue, and we're going to reduce the liability account because remember, if we don't perform the service, we owe the customer that money back. So unearned revenue is a liability because we potentially owe it to someone. The adjustment for unearned revenue is a decrease to a liability and an increase to a revenue account. This just restates what I just said. We're going to decrease our liabilities and increase our revenues. Now, notice this. This is all on the same side of the accounting equation. Now, if you remember, Sierra had received $1,200 from someone for guide services. Have we completed any of those services? And the answer is yes. We earned $400 of that in October. Customer hasn't yet been billed, but we have earned that revenue. So we're going to decrease our unearned revenue and increase our earned revenue. These are examples of things that might be unearned revenues. If we don't make these adjustments, it would appear that our liabilities were overstated, meaning we would be showing more in liabilities that we actually had. Our revenue would be understated, meaning we're not showing all of our income. It affects more than just one financial statement. Accruals. Revenue for services performed, expenses incurred in the current accounting period that have not been recognized because maybe they're not quite complete. Maybe a bill or an invoice has not yet been generated, but either the expense was incurred or the revenue was earned, so we must make these adjustments. If we're recording revenue that has not yet been recorded and we have not been paid for, it's an accrued revenue. I always like this one to think about interest earned. If I have money invested somewhere and I'm earning interest on that money, I haven't received that money. Whatever investment I have it in hasn't paid out yet, but I've earned that interest. Accrued revenue shows that there is a receivable. So if I have earned interest, it would be interest earned, interest income, and interest receivable. Or it's recording the revenue. So it serves two purposes. It makes our assets correct and it makes our revenues correct. Accrued revenues will increase an asset account and increase a revenue account. All right, so Sierra performed some guide services for 200 that were not billed, probably because they were going with the same company on November 2nd to continue the trip or do additional services, and they were going to send one invoice for the entire package. But we earned the $200 in October, so we want to record that. We haven't been paid for it, so it's a receivable, and we've earned it, so it's revenue. So we will increase our receivables, and we will increase our revenues. If we do not do this, our assets, which includes accounts receivable, would be understated, meaning we're not showing as many assets as we truly have. Our revenues would be understated because we're not showing all the revenues that we earned. It's important that you understand these concepts of understated and overstated, because you might be asked, what would be the result of either doing this or not doing this? And understanding these concepts will be important. Accrued expenses. We've incurred the expenses, but they're not recorded and they've not yet been paid. So what would those things be? Interest expense. I have a loan that I have to pay interest on, and that interest accrues every month. What about wages? Do you get paid every day for the work that you did that day? No, generally speaking, you get paid like a week later for the work that you did. But those expenses were in that month, so we need to accrue them. We're going to record the obligation, record the liability, and we'll also at the same time recognize the expense. This follows the principles that we learned. We're recognizing the expense in the month in which it was incurred. We'll increase an expense account and increase a liability account when we're accruing expenses. Sierra signed a 3-month note, amount of $5,000. We were to pay interest at the annual rate of 12%. Do you know how to calculate interest? Principal times rate times time. And I believe we will always use very simplified time, months, and we are calculating interest for 1 month. So it would be $5,000 times 12% times 1 divided by 12 to get $50. You can put this in your calculator and just run it straight through. 5,000 times 0.12 times 1 divided by 12 to get your answer, or do the calculation in a formula just like that on an Excel spreadsheet. So here, interest payable, because this time we owe the interest, and interest expense. Accrued salaries. They paid, their last payroll was on October 26th, and the next payroll will not be to the 9th. The employees earn $400 per day. So between the 26th and the 31st, there were 3 working days. 29th, the 30th, and the 31st. So we have salaries payable of $1,200 for those 3 days. Those expenses were incurred over those 3 days, but because payroll has not yet been run, they have not been recognized or in the books. So we will recognize them because the wages were incurred in the month of October. And our entry will look like this: salary and wages payable and salary wages expense. There's various things that can become accrued expenses. And this is important. If we do not do the adjustments, our expenses are understated and our liabilities are understated. This summary might be one that you would like to print because it will help you as you work on your projects and work on your homework and spreadsheets to understand what you're doing and why you're doing it. We can then take our spreadsheet and prepare our adjusted financial statements. These statements are now the correct, accurate, timely, and usable financial statements for the company, as opposed to the unadjusted financials we prepared at the end of Chapter 3. So using these numbers, we have prepared our income statement. And again, remember, our net income comes down to our retained earnings. Our retained earnings comes over to our balance sheet, and we pick up the rest of our numbers from our spreadsheet. And our balance sheet must balance. Very important. We now have financial statements that, to the best of our knowledge, are accurate, and that's what we need. Now, I know this is rather confusing. It's not anything you've done before. So I would encourage you to watch the videos that are supplied from Wiley Plus that will help you work through the spreadsheets and show you again just how we develop the spreadsheets and how we come up with the numbers that we need to make our adjustments. Thank you very much.